This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview. For the second time, it's Zach Phillips, the advisor to Oak Securities. Of course, Zach, we spoke before. You did a research note on Helix exploration. Well, today we're going to be discussing your research note on Georgina Energy. Well, thank you very much for joining us. How are you doing?
Very well, thank you very much, and thank you for having me on.
No, absolutely. I'm looking forward to going through this research note. The purpose really is to go through the note, look at the valuation, how you've come to that calculation. We'll talk about some of the milestones needed from the company to actually realise that valuation, and of course, we'll assess some of the risk factors there that could hinder this opportunity here, and hopefully shareholders can get a better understanding of the opportunity that's available, the risks associated, and also some rationale behind the valuation that you've put on the company here. And your target price is 124 pence. And as of the research note being published, the price of Georgina was indeed 13.5 pence. And that puts a market cap on the company with your valuation of 124p at 142 million. So, a pretty big upside. I think you've actually said an 8.1x the current price, not quite a 10x, but an 8.1x the current price there. So, just to start us off, Zach, maybe just in a few words of your own, perhaps just give us your thoughts around Georgina, the company. This valuation of sort of 8 times, or actually I've read that wrong. I think it's 9.1, isn't it? 9.1. So nearly a 10x. Why you're sort of saying possibly nearly a 10x here on this company?
Well, I think the first thing that we have to realize is that helium is 2 orders of magnitude higher in terms of per unit price than its comparable natural gas equivalent. And that has a significant impact because although there is a lot of additional equipment and costs that go into the winning and sale of helium, it's not too dissimilar from oil and gas operations. So in effect, you've got an oil and gas cost base and advantages of scale allied with a disproportionately large sales price. Now, that's the same for all helium plays, of course, but the additional factor that we have here is that the scale of the accumulations that are being targeted are significant, and they are absolutely beyond what we've seen in the market to date, and the combination of those 2 factors really means that you've got a significant resource base, which can give you a significant opportunity.
Okay, well, you've used this DCF, this discounted cash flow methodology. So I'm just looking now. I'm sort of starting on page 3, really, here, for anyone following the research note with us. So the valuation there of 142 million US dollars, or 124 pence. So perhaps just first of all, can you explain the discounted cash flow methodology that you've used to value the assets here at 142 million?
Yeah, first of all, we assess the value in a success-based case. So that's effectively your unrisked valuation. Now, what we then do is we layer in the individual risks as they relate to getting to that success. And in this instance, what we have said is that despite the fact that there have been reports that there are above background levels of helium present in the produced gas, we're saying, well, okay, let's assume that those are incorrect, and that you have got some issues with source, and the helium could have come from somewhere else, or it could have been a false positive. Because let's not forget that these reports are quite old.
Mm.
And technology in the last 20 years has come along a long way, let alone in the last 40 years. And don't forget that helium wasn't generally a gas that you targeted when you were doing your spectrometry. Indeed, helium is usually used as a carrier gas so that you could carry the other gases through. So, unless you specified in your testing, which wasn't that often, to be fair, that you were looking for helium, you generally didn't look for helium in your spectrometry. But that said, the reports do say that there's been between 5 and 8% helium by volume in the recovered gases. And the key thing here is to what extent do we believe what they're telling us? Now
Mm.
we along with the competent person have chosen to say, well, it's not too reliable, and we do want to we do want to be quite pragmatic in how we approach these things. So the combination of source, seal, trap, reservoir, and producibility all really give you a geological chance of success of between 15.5% and 16%. Now,
Okay.
to that, we've added on a number of additional risk factors, which have taken to between 55 and 75% of that geological chance of success through to the overall chance of success. Now, that in essence means that the risks between where we are today and a successful outcome are in Mount Winter's case is around about 89%. But in the Hazar's case, it's 91% risk. So our chance of success is 8.8% in Hazar and 11.8 in Mount Winter.
Okay, and that sort of puts you really on a exploration sort of style, doesn't it? And I notice on this is on page 3 at the NAV valuation, you say Oak considers all the company's assets to be at the exploration stage. And I know when we've spoken to people at Georgina before, Tony Hamilton, the CEO there, he's very keen to remind people that this is not an exploration play, that this is a well redevelopment. So, I mean, but you've based the valuation here on it being an exploration play. And is that, I wonder if you can get some more rationales to behind that. I mean, you mentioned there the resources are perhaps not too reliable. Any other factors here that have made you determine this play, let's say the Georgina Energy helium play, as an exploration company rather than more advanced than that?
Well, I think the key thing here is the fact that it's been so long, and
Okay.
that the if you like, the search for helium hasn't really been the main focus for a lot of drilling in Australia or in the United States for a very long time. The majority of drilling is focused on oil and gas. And it's what we're trying to do is make a realistic assessment of where we think the data quality actually is. Now, you can go and you can do geochem studies. You can go and do further desktop studies to de-risk it. But at some point, you've got to weigh up the costs and say, well, all of these additional studies and all of these additional bits of scientific equipment that you want to bring to bear costs money. And given that you've got two wells that you're going to re-enter, which substantially reduces the cost of that initial work program, what you can actually do is say, well, you know what? it's better that we just re-enter the wells, drill out the plugs, recomplete, and let it flow.
Mm.
Let's just get down there and measure it ourselves in 2024. And I think the management team have been quite pragmatic when they've looked at that, and they've said, well, on balance, to repeat the work that's been done, we're going to have to spend another $5 to $10 million. Why don't we just go straight to the well workover and re-entry and spend half that amount of money to get to the same place?
Okay. Yeah.
So
Okay. And you mentioned just earlier there that there hasn't been very much exploration. Is that because the world has not actually needed, there's been enough supply of helium that we've not had to actually go and explore for it?
no, I mean, not at all. There's a huge demand for helium, and in fact, we're in a little bit of a deficit at the moment. The demand side is really starting to accelerate as we move into AI, and the demand for chips and
Okay.
and specialist equipment surges. Your demand for helium isn't going to go down. Up until this point, helium has really been coincident with natural gas, and you've been able to eke out returns from sub 1% helium. A, because of the prices, but B, because the economics of it is largely supported by the oil and gas component, or rather the natural gas component. The dedicated helium exploration is relatively novel, um, but that doesn't mean to say that it's not got a significant market supporting its drive, because it most certainly has. That the only thing that stops a global meltdown in the helium market and prices skyrocketing is the federal helium reserve in the US. I mean, for OPEC, think the US for helium, when it comes to balancing that world demand. So it's not really a surge in supply. It's just a reduction in the deficit, and there is still a significant deficit of helium.
Right. Okay. Okay. And just finishing off on this valuation calculation. On again, this is still on. This is on page 5 now. You talk about this Monte Carlo simulation where you've got 90% probability, 50%, and 10%. Again, could you just explain this Monte Carlo simulation and how that ties in to your valuation here for Georgina?
Yeah, I mean, it's using probabilistic distributions and ranges of distributions to alight at a valuation curve that gives us confidence that the low, the best, and the high values will be reached. Now, for those that are used to Excel, generally we can only work in 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 variability in terms of two factors. So you'll use price, and you'll use, let's say, SPE PRMS recoverability. But with Monte Carlo, you can have any number of of variables going into a single economic model, and we use 40 different variables, amongst which is the SPE PRMS case,
Mm-hmm.
the well type that can be experienced by the completion, and prices, as well as inflation, and a whole host of other factors such as gross rock volume and saturation, so that we get a complete operating envelope across all of the input factors. And from that, we get a single set of results that allows us to really look at the worst of the worst case and the best of the best case and everything in between. So you know,
Okay.
for us, it's more a real life tool that allows us to reflect the wide variability of outputs that can result from the significant number and range of inputs.
Okay. Okay. Excellent. Well, thank you for that, Zach. So we will talk about risks in a moment, but before we get on to that, I mean, the company have obviously got a work program. They've got to go and re-enter these wells and see what is down there, what they hope is down there is down there. So we need to go through to understand what perhaps the company needs to do in order to start moving up that value curve and perhaps getting closer to that 124 pence price per share target that you put on the company there. So in terms of some of the milestones needed, or the company, the critical steps that Georgina must take to achieve that projected valuation. On the exploration and development side there, what are the key exploration milestones that Georgina needs to achieve for both the Mount Winter and the Hussar projects?
Well, I think in the first instance, they've got to re-enter and recover a gas sample. I think that will be relatively easy
Okay.
to accomplish. That really solidifies your source. Uh, Hopefully, it will then allow them to do a little bit of flow work so that they can recover um, some of the gases and allow it to flow so that they can understand the deliverability of the well. But I think, in all honesty, I think for the very first well or the re-entry, you've got to be prepared for the well to not be in great condition. It's been there in some
Mm.
instances for 30, 40 years. So it's not going to be in great condition. You'll re-enter the well if you can get just a little trickle of flow so that you can get a sustained rate. That would be fantastic. But what you're really looking for is confirmation of that, of the gas content of the um, of the accumulation. The next
Okay.
thing that you could do is, depending on the condition of the well, is recomplete and perhaps undertake a flow study. So whether the reservoir is sufficiently permeable to deliver a significant volume of gas straight away or not. I think that remains to be seen. But I think if we could get just two items from this, the confirmation of presence and an indication of deliverability, I think it would be a successful outcome for the company.
Right. Okay. Okay. Yes. And I mean, you say that sort of on page. I'm just looking at page 12 now on the work program there, where you've got exploration and appraisal, and then development. So, of course, the first thing to do is to re-enter that, and as you say, achieve a sample. And then, really, what comes after that? I mean, you talk about a flow study, so that would be getting a flow going and effectively monitoring that flow. And would that give an idea of the pressure that's down there, if it's commercial, and then how do you determine the actual reserve as well?
Well, I think that's going to be a matter for the geos and the reservoir
Mm.
engineers. But what they will do is, they'll look to do as significant a drawdown program as they can, so that they can do a probably they'll if we look at let's say they have a successful outcome on the re-entry. I would imagine that the next stage will be raising money for a second appraisal well. Your second appraisal well will target will be a completely new well, which will be specifically designed to test the deliverability of the reservoir. From that, you will also probably take some core so that you can understand the variability in the horizontal and vertical permeability, the porosity, and get a better understanding of the characterization of the reservoir. from that, you'll reintegrate it into your seismic. You may even shoot some additional seismic if you don't think you've got enough. But then your third appraisal well will most likely be focused on drilling the limit of where you expect your reservoir to be. And it depends what kind of reservoir we're talking about here. If we're talking about a lenticular sand package, well, you're not going to you're not going to be drilling the extent of and trying to prove a lenticular sand package. But what you will want to try and do, for example, is if you've got an anticlinal structure, which both of these are, you're going to want to try and find the lowest known what we used to call lowest known hydrocarbons, so either lowest known oil or lowest known gas. But in this case, you'll want to find the lowest known gas before it gets to either a water or a sealing fault or whatever it is, so that you can then calculate the total rock volume. And
Okay.
from your porosity and water saturation work, you'll then be able to figure out what percentage of that is given over to the gas. And then from that, you'll be able to work out how many wells you're going to need from the porosity and permeability studies that you'll do from the core. So all in all, I mean, that there is a body of work that will be required after the initial the initial program to get it into a position where you can articulate a field development plan, get that authorized, and then start the job of drilling out and installing your infrastructure.
Okay. And this, I think you cover on, I think it's page 17, where there's that table and the little icons of drilling rigs. So we're talking here about, you've got Mount Winton, you've got Hussar there, and the exploration well. So that sort of re-entering happening. I know at Hussar before the end of the year, I think is what Tony has said before. At Mount Winter, I don't know when, but during the course of 2025, one would hope it would be the H1 of 2025. Then moving into that appraisal section where you, as you say, you drill a few more wells to prove up a bit more. And are you projecting, therefore, if that all goes to plan, of course, there are risks that we'll talk about in a moment here, that first gas, in terms of actual production flows of gas on a commercial level, will happen in 2029?
Yes, and I think what we're assuming there is that you're not developing 100% of the field in one go. That you have a small bespoke modular development to start with that generates your cash flow, and then you reinvest that cash flow to 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 develop the field further.
Mm.
So it's a progressive development that we're anticipating. I think if they are successful, I would imagine that given the size of the prize here, that you would get farm-in partners quite easily. Or even because it's a public company, it would instantly become a target.
Okay.
So I wouldn't envisage in a success case that Georgina will be developing its accumulations. If it proves up what it says is there, either the Australian government will declare it a strategic asset and buy the company off the market, or it will say that, right, we are your de facto farm-in partner. We nominate X to farm in with you, and this is what's going to happen.
Okay.
I think Australia is far more able to do to be protective in that manner
Okay.
than say the United States, simply because it this is something that is so significant and is so large that I just don't think that I think the scale is quite impressive.
So it could become a strategic asset to the Australian government and the Australian economy.
Absolutely,
Okay.
absolutely, and I think that's reflected not only in our in the price that we've used as a benchmark, which is about $338 US dollars per thousand cubic feet,
Mm,
but also in the fact that we do see a an accelerated program to 2029. But again, it's all going to come down to size. And as we've said, there is a wide range of 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 factors here that in extremis can lead to in excess of you know billions of dollars, 8, 9, 10 billion dollars NPV, and others that basically say, well, unlucky, and away you go. And
hmm
it's not intersected anything, and the reports were false. So
Okay.
somewhere in between there is going to be the point at which this asset becomes strategic. If it falls below that trigger point, and I can't tell you what that trigger point will be, but if it falls below that trigger point, I think you'll get more of a piecemeal development. If it's above that trigger point, I think you'll get a significant body of support from the Australian government, possibly even stepping in and actually offering to build the plant and provide offtake, with
Mm,
with Georgina being paid a nominal fee for the winning and sale of the gas.
okay.
I don't
Okay.
know. It's too early to tell at this stage.
Yes, it's early to tell on that stage, but that's a very very interesting point to kind of hang on to as a longer term picture of what could happen here. And just finishing off on looking at some of those numbers there as we go through, as the company goes through those different development milestones over the years. We talked about this before, but that dollar MM basically means million, doesn't it? $1 million. So am I right
That's
in
correct.
understanding that? So to get to first gas around 2029, you're looking at just shy of a total spend of 4,000 million, which would be 4 billion.
That's right. But
Okay,
what we're assuming there is that you drill a body of wells and you maximize economic recovery. It may well be that somewhere in there is an optimum and a piecemeal development scenario. For
right.
example, I mean, if you wanted to look at a modular helium unit, you can get away with 20, 30 million dollars on a single well, and start to deliver it piecemeal. But as we sit here today,
Right.
the optimum development program is actually
Okay.
a single development with a large initial flow rate.
So that's the optimum, as if everything went swimmingly well. There was lots of gas there. The pressure was good. Everything looked really good. You had interest from other parties, interest from the government. That's sort of the optimal route. And at that point, getting hold of that kind of money is probably not that difficult.
Correct. Correct.
Okay. And then the piecemeal approach would be, yeah, you build up slowly, you start selling gas, you get some cash flow in to help keep on funding and reinvesting to sort of build out in a more, piecemeal, slow approach.
That's right. I mean, both
Okay.
both are profitable and
Yeah.
will generate significant NPVs. But I think for in our analysis, going for a single large gas plant with connected infrastructure, you get the economy of scale
Mm,
locked in, but
mm.
you also develop the gas resource in the minimum amount of time.
And your valuation then, at sort of what point during that development sort of curve, those development milestones, or the years, however we want to look at it, what point does that 124 pence, that market cap there of 140 billion, wasn't it? If I can, not billion, million even, 142 million. At what point do you think that becomes realistic? Is it sort of after the first appraisal wells? Is it going into, sorry, the first exploration wells, the re-entering or moving into the appraisal side, or is it when we're getting to development side? Just before, if we're looking at that table there on page 17, just before the sort of the big capex perhaps comes in, if they're going down that route. So we're talking sort of 2026. I mean, if you're thinking about putting a timeline, if you like, on that valuation, where would that sit on that sort of development table there?
Well, the valuation of $142 million is today's appraised value of the portfolio as it stands today. So that's before you have any drilling, before you have anything further. That is
Right.
that is what it's worth today, in
That's
our
what it's
opinion.
worth today at the moment. Okay, so a
Correct.
significant discount to what is actually trading at. So okay, the obvious question there is why the market?
Well,
What's is the market broken? Does the market not get it? The old phrase, "The market's never wrong." Why don't you think it's valuing it at what you feel is today's value?
well, I think for that you need to know the difference between value and worth. Now,
Okay.
valuation, and we always say this, is that value is a quasi-scientific approach. It's made up of a number of inputs that all come together to give you a, a value. And as we've said, you've got on the one hand you've got the P90 value, you've got the P50 value, and you've got the P10. And you've got to remember what that actually means is that it's the value. The P90 means that the value that corresponds to the P90 is the value at which you would expect 90% of all other values in our broad world of valuation ranges and valuation combinations to exceed. 50%, it's likely to exceed it to 50% of the time, and of course 10% is the P10 is that the value corresponds to the value that only 10% of all the values exceed. Now, the reason why there's a significant difference between value and worth is because you can't take into account the things that people look at and try and factor in beyond those quasi scientific elements. So, you know, people might be looking at the likelihood of Georgina reaching that versus, say, someone somewhere else. And it. I think that to to understand the market value, which is effectively giving you the worth of all of the risks and all of the financings and all of the everything between now and the success case. It's telling you that it just assesses the risk to a greater extent. And I think at some point you take you have to take a view. And what we do is we try and say, okay, well, what does that tell us across the whole gamut of things? And the P90 value is zero. It does show you that if your P90 value is zero, then you've got is a position where the market is saying, well, I'm looking at the difference between putting my money in and making a return versus putting my money in and
Mm,
making a loss. So
mm,
the market looks at things on a much more holistic way,
mm,
and doesn't, what you're your Monte Carlo valuation model can't tell you is what the is what the respective individual investor
Mm.
will look at and will say is a fair risk.
But are we talking here about sort of an ideal world? Because for we talked about, or you mentioned earlier about Georgina being really an exploration. You valued it as an exploration play. That sort of 15%, yeah, probability of an economical success. I mean, if you look at the market broadly, any exploration company at the minute that's valued at 100 million would be, pretty significant. There's not many out there at the moment that are valued at that. And I mean, there are companies who have deposits of commodities. They have production plants in place. They're not even worth 100 million. Then you look at other companies who've got big players involved. Rio, for example, joint venturing on a company that I follow quite a lot. Sovereign Metals, for example. They are valued at that kind of level. They are up there, but they are so much more developed. They have so much more of a resource there, and of course they've got the influence of Rio being involved, and they're down that development path. I mean, a lot of it is sentiment. How exciting is this story? Does it have investors' interest? But I mean, 142 million for an exploration play, I would say, in my opinion, that's significant. That's really, really high. So I mean, are we talking here in a sort of an ideal world of, the mining cycle is on that going towards the peak on the graph rather than perhaps where it is now? I don't know where to point it. I mean, what do you think? Because presumably you look at a lot of companies in this sector. That is a high valuation, I would say, for a company that is basically very much at the sort of exploration stage.
Yeah, but you've also got to say, well, what is your basis? And we do have to say that mining is not like oil and gas. Or gaseous natural resources, because for gaseous natural resources, and certainly for helium, there's a significant investment that you need to put in before you get to the payoff. You've almost got to put in all of your investment before you get to first revenue. Whereas in metals and mining, it's not necessarily that you don't necessarily follow that arc, and it's also it's not just about percentage for accumulations. It's not just about percentage and whether it's there. It's whether it will flow.
Okay.
And for that, you need look no further than some of the huge deposits that you've got in Venezuela that dwarf Saudi Arabia, but they're not reserves because they'll never flow under current technology. So it's not just about presence. You've got the additional complication of is it's got to flow through the rock core. And if you can't make the rock pores, do you frack? Will that make a difference? That's what you've got to. You've really got. Pardon me. You've really got to understand is that once you've found it, now you've got to get it out, and it's pointless if you can't get it out. But again, it comes down to where do you draw the line and where do you put the boundary? Now, if you're going to factor in fundraising and ability to meet cash calls, that would be an impossibly complicated model in which to articulate a meaningful valuation. So you're far better off valuing the asset on its technical merit and letting the market do its job. And I think that's what we do, is that we value it technically and we let the market, divine the difference between value and worth.
Well, I do want to finish off, Zach, by talking about risks, of course, risk factors. And having gone through the report and listening to you talk to me today, I'm going to list off some of the risks that I'm feeling could be a factor here, and you can tell me if I've got them right or if there's any more to add, and maybe we can talk a little bit about them. But I think, first of all, you've got the helium pricing element, of course, the fluctuations in pricing. But a key point to that was how the government might cap it, and we can talk about that in a moment, looking at the disparity between sort of the open market versus the actual price that the government might set. The other factor, of course, is capex, so the ability to raise money, to get money in place to actually do the work that needs to be done to prove up these wells. Also, the jurisdiction, i.e. Australia. The research note talks a fair bit about the distances involved in Australia, logistical availability of rigs, that kind of thing. And then, of course, you mentioned earlier about the actual, as it goes without saying, almost an exploration, but the exploration risk, the fact that sort of the old reports perhaps aren't right, and that will be determined, well, I guess fairly soon as they re-enter the well. So I've got sort of 4 key risks. Have I missed any off?
No. I think that's fair.
Okay, good. Well, let's just have a quick look at the helium pricing then, and let's just talk a little bit about the open market versus governments. Why are the governments intervening here?
Well, of course, the government isn't intervening because the government can't intervene in a market that doesn't exist in Australia. The last observable import price from the United States to Australia exceeded $1,200 per 1,000 cubic feet. Now that's a significant price. I mean, and that's 3 orders of magnitude bigger than the US price for natural gas, for example. So there is a significant disparity between, or not disparity. There's a significant difference between what the US Federal Reserve will sell its gas for on a long-term supply contract, which at the moment is about $420 to $500 per 1,000 cubic feet, and what the open market will support, which I think the last observed price was around about $1,400 per 1,000 cubic feet. So there's a significant range of $1,000 difference between, if you like, a regulated, but it's not really regulated price. It's a long-term supply price, and what is really a spot price for immediate delivery, for want of a better word.
Okay.
So you've got that pricing boundary and envelope is significant. Now, in Australia, the government and the approach that's taken is a lot more restrictive. If you like, the US, even though it's a Democrat in the White House, is very open market and free market economy. In Australia, I certainly from my experience, if the Australian government doesn't like something, it will regulate it, and it will regulate it to within an inch of its life. Witness what happened with fracking for a while in Queensland. So I've taken the risk that, if they've got domestic gas, they are definitely going to intervene, so that Australia first is the mandate that's pursued. Now, if there's enough for them to export, I would imagine that they would do free market export and would promote somebody paying $1,400, $1,500 per 1,000 cubic feet for exports. But for Australian demand and for Australian use, I would imagine that they're going to regulate the market.
Right. Okay. And that would basically affect the profitability of a helium producer in Australia.
Yeah, I mean, I think it's relative.
Okay.
If you compare it to the profitability of gas in Australia, helium is going to be 2 orders of magnitude different. And yes, there's an additional complications involved in the more complicated development infrastructure that be required. But you're talking about making making an IRR of 200% versus an IRR of 400%.
Okay.
Between the two, versus if it were just plain natural gas, maybe 50 or 60%. So,
Mm.
you're talking about incremental differences on what are already large numbers.
Okay. Well, in terms of capex, then of course I think that's pretty straightforward. The company would need to go through those milestones in order to attract the attention of investors or indeed bigger players to then raise further funds in order to progress down the route. But as on that table, for the first sort of 2 years, the capex is not crazy. I mean, would you agree on that?
Yeah, I think what you've got is a fairly I don't want to say simple and straightforward, but it's going to be a work program that a lot of oil and gas investors will recognize.
Right.
It
Okay.
will be about articulating the deliverability of a well. It'll be
Hmm.
about trying to assess the boundary conditions and optimize the well design. From the optimized well design, then you get into whether you're going to go for a piecemeal approach or you're going to go for a wholesale development approach. My guess is that it'll be somewhere in between. We've provided the optimum NPV development approach, which will maximize NPV from today. But of course, as you roll out the spend, each year the NPV will improve as the capex that's invested falls off the NPV calculation. That so-called project procession effect. So it may well be that the the design and the availability, the design of the wells, the availability of infrastructure, and the availability of funding means that you can go for an all singing, all dancing single development opposed to a piecemeal approach.
Okay.
That all
Okay.
remains to be seen.
Indeed. And just a final point then on the sort of the jurisdiction, Australia then. I know that was a risk factor that you put in the research note here. You're talking about availability of rigs, but also just the sheer distance in Australia. What's your thinking behind here then? How much of a risk is that? I mean, of course, Australia is a very good place to do business, a very good place to do exploration and mining, but it does obviously come with some cons as well.
Yeah, and it's not to my mind it's only you're only talking about costs here.
Okay.
Whereas in the United States, nearly every state is of a size and has a sufficiently mature oil and gas business to say that your mob demob costs are going to be minimal in comparison to your actual drilling costs. In Australia, because you've got a couple of localized onshore basins, I think you the attention that you're going to pay to the impact of mob demob costs is going to be higher than it would be, say, in the United States, and so too for infrastructure. To get from any port to the middle of Australia is a significant undertaking. It's by road train it can be days, and it depends on the material that you're hauling and the size of your load. So it just adds a layer of complexity, a layer of planning, and a layer of cost that you might not necessarily face elsewhere in the world. Now that it's there's nothing here that is super special. There's nothing here that will make you think, okay, we've got to devise a new technology or a new methodology or a new approach. Everything to develop, if they are successful, is vanilla and largely off the shelf. So to my mind, it's about putting it together in the most effective way possible and using a program that leverages as much cross compatibility as you possibly can. And again, there is just no getting over the distances. You're just going to have to figure that into your delivery costs.
Okay. Well, thank you very much, Zach. That's a very good deep dive and digest of that research notes. Thank you very much for your time again. And well, we will certainly be following the news here at Stockbox with Georgina as they're getting into that first re-entry. Yes, Q4. So we're getting into that fairly soon. And maybe we can catch up again as they hit some of those milestones and see how that might affect or change your valuation. But for now, Zach, thank you very much for your time.
Pleasure.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stopboxmedia.com. Thank you for watching.